All right, let's set the scene. You've downloaded a trading app, you see a stock you like, and you hit buy. The price goes up a little, you're feeling pretty smart. But then it drops. Not by a lot, just 3%. But you check your account and somehow you are down a whopping 15%. The math just doesn't seem to add up, right? So how is that possible? How can such a tiny little move in the market cause such a huge, painful dent in your account? This is the exact question we're going to answer right now, because honestly, it's the #1 trap that catches new traders. And the answer? Well, it's surprisingly simple.
It's because what you bought wasn't actually a stock. You were trading something called a CFD, a contract for difference. And the second you truly get that it's a contract, not an asset you own, that one little word changes absolutely everything about how you see the market. Okay, so let's really dig into this. What does it actually mean when we say you're trading a contract instead of owning the asset itself?
A CFD is basically exactly what it sounds like. It's a formal agreement, a contract, between you and your broker. You're both agreeing to exchange the difference in an asset's price from the moment you open the trade to the moment you close it. Now, the most important part here, the part you can't forget, is that you never actually own the underlying asset. No shares, no voting rights, no dividends. You're just making an agreement on which way you think the price is going to go.
You know, the easiest way to wrap your head around this is to just forget about finance for a second. Let's think about something way simpler, like a bet on a football game. Imagine you and a friend are watching the big game. You're sure Team A is going to win. Your friend is convinced it'll be Team B. So you shake on it, a simple $10 bet. When the game's over, the loser hands the winner $10. Now, let me ask you, did either of you own the football team? Of course not. You just had an agreement, a contract on the outcome, and you settled the difference. That handshake, that's a CFD. You and your broker are just shaking hands on a price direction.
Now, because this CFD is a contract, it allows for something that traditional investing doesn't. It's a little thing called leverage. And this is, without a doubt, the most important, and by far the most dangerous feature of CFD trading. Think of it like a giant financial magnifying glass. Let's look at this side by side. If you want to buy $10,000 worth of actual Nike stock, well, you need $10,000. Simple, right? But to get $10,000 of exposure to gold using a CFD, your broker might only ask you to put up a small, good faith deposit. We call that margin. And in this case, it might only be $500.
Just think about that for a second. $500. That's all you need to put up front. It's kind of like a security deposit for your trade. And that $500 is now pulling the strings on a $10,000 position in the gold market. This incredible relationship, using a tiny amount of your own money to control a much, much larger position, that's what we call leverage.
I mean, this chart really says it all. See that tiny little sliver? That's your own money, your margin. And that massive bar next to it, that is your total exposure in the market. You can see why they call it leverage. It gives a very small amount of cash some serious muscle. But that muscle cuts both ways.
Okay, this is absolutely the most critical point. If you only remember one thing from this whole explainer, please make it this. Your profit, or your loss, is not calculated on your small $500 deposit. It is calculated on the full $10,000 exposure. This is the mistake that trips up almost every single beginner.
And here's what that looks like in reality. If the price of gold drops by just 5%, well, 5% of a $10,000 position is a $500 loss. And what was your initial deposit? $500. So a tiny 5% dip in the market has just completely wiped out 100% of the money you put into that trade. In one move, it's all gone.
So let's make this super concrete. We're going to look at the exact same trade on Apple stock, but we're going to watch it unfold through the eyes of two very different traders, a total beginner and a seasoned pro.
Just look at the difference in their thinking from the very start. The beginner is running on emotion, on a gut feeling. I'm sure it's going up. The pro, they're not thinking about being right. They're thinking about what happens if they're wrong. Their very first thought is, how much am I willing to lose on this idea? They both take the exact same action, buying 50 contracts, but their plans for risk couldn't be more different.
So here's how it plays out for our beginner. They jump in, controlling $10,000 of Apple stock, but they have no safety net, no stop loss. Then the stock drops $16 a share. That loss gets calculated on the whole position. $16 times 50 contracts is an $800 loss. That's 40% of their margin, just vaporized on one trade. They start to panic, they hold on, and the loss just gets bigger.
Now let's watch the pro handle the exact same losing trade.
Before they even clicked buy, they decided their maximum pain point was a $200 loss, so they put in a stop-loss order at 196. As the price starts to fall, their broker's system automatically closes the trade for them at their predefined exit. The total damage? $4 a share times 50 contracts, exactly $200 just as they planned. They were both wrong about the direction, but only one of them lived to trade another day. Oh, and one last thing the shiny ads don't really mention. Because you're using leverage, you're essentially renting that big market position from your broker. And just like rent, there's usually a small fee if you hold that position open overnight. People call it an overnight fee, or a swap. It's usually a tiny amount, but if you're holding a trade for weeks or months, those little costs can really start to add up.
All of this, the contracts, the leverage, the risk, the fees, it can all be boiled down to one simple, powerful rule. We like to call it the renter's rule.
And here it is. A CFD is a contract, not an asset. You are renting market exposure. You are not buying ownership. You have to respect the leverage, you have to define your exit before you even think about your entry, and you never, ever risk more money than you can calmly afford to lose. That right there, that's the difference between trading and just gambling.
So now you get the instrument. You understand that a CFD is a leveraged contract, and that having a risk plan isn't optional, it's essential. But, knowing how the tool works is only half the battle. The next big question is, how do you actually read what the market is telling you? Understanding a contract is step one. Learning the language the market speaks, well, we'll dive into that in our next explainer.